Hello and welcome to BQ Prime. You're watching IPO Adda, and my guest today is from Inox Green Energy Services. The company is coming out with an IPO with a price band of 61 to 65 rupees a share, with a fresh issue of 370 crores and an offer for sale of nearly 370 crores. The company is valued at nearly 1897 crores at the upper end of the price band. And joining me is Mr. Devansh Jain, who is the ED for the Inox GFL Group. The company is part of the InoxGFL Group, which also has Gujarat Fluorocarbons and other companies like Inox Winds as well there. Mr. Jain, thank you very much for joining us on BQ Prime. To begin with, you are raising 370 odd crores through a fresh issue. Can you give us an idea of where is it's going to be used for?
Thank you, Sajid. It's a pleasure to be on BQ Prime. As you mentioned, we've announced our IPO at a price band of 61 to 65. The anchor is on the 10th. The issue opening date is 11th, and we close on the 15th. As you mentioned, the primary proceeds are 370 crores. We intend to use these proceeds towards debt repayment. 270 crores is towards debt repayment, and 100 odd crores is towards general corporate purposes, which in all probability is going to be used towards debt repayment itself.
Okay, give me a sense of the business model that you have, because you are linked to the entire group. You are part of the renewable space as well. What is the business model and revenue model for you?
So we are basically one of the largest wind O&M service providers in the country. We manage about 3 gigawatts of fleet on a pan-India basis. It's basically an annuity business, if I may say so, but we have a very, very high growth. We've grown at a CAGR of about 40% over the past 9 years, including the period when the wind sector went through a transition. So very reliable, stable cash flows. The business model basically involves servicing renewable energy equipment. Given the demand which is expected to take place, given that we have a 500 gigawatt target by 2030 in India, we're seeing explosive growth to take place on the renewable energy side. And at the end of the day, you need servicing of renewable energy equipment. So I think Inox Green is primarily a company which services the renewable energy equipment, a very high margins, annuity business with built-in escalations. So I think very niche but very exciting business model.
Interesting that you're in the services business. Tell me, how is it that you have a debt of nearly 1,000 odd crores? Because in the services business, there's not much of capex required there, right? So it's more of a people-oriented one and servicing of this existing thing. So how is it you are able to have this higher debt component in your business?
So, Sajid, a very relevant question, if I may say so. This business requires zero debt. It's a cash flow business which throws up capital and cash. What's happened is it's a subsidiary of Inox Wind. Inox Wind was an entity, as many people may know, the wind sector in India went through a painful transition from feed-in tariffs to auctions. And today, the renewable energy sector is on a massive comeback. We're seeing explosive growth, very, very high growth on the wind energy side, massive targets announced by the private sector and public sector enterprises. Now, within that, when the sector went through this transition, as I mentioned, the O&M services company is a long-term annuity business. So bankers were very comfortable lending to this entity as opposed to the equipment manufacturing entity. So what's happened is we have 370 or 400 odd crores of debt under Inox Green. If I may mention, it's about 800 crores of debt, which you see on the balance sheet at this point in time. So 400 odd crores is the debt which belongs which will go out with the primary proceeds of the IPO. What we also have is a 50 megawatt SPV under this entity. We've sold 4 such SPVs, 3 to Adani, 1 to Torrent in the recent past. This is the last SPV on our balance sheet, which is worth 300 odd crores. We expect to downsell this over the next couple of months. Once we do that, 300 odd crores of the SPV and equity value goes away. So effectively, what you will be left with is a zero debt entity. The last 100 odd crores has already come into the entity thanks to the 4 SPVs we sold over the past couple of months. So effectively, with the 400 proceeds coming in from the IPO and the 50 megawatt being downsold, just like we've sold 4 other SPVs, this entity will be a net debt-free entity.
How much will you be selling that for? Around 300 odd crores?
So broadly, we've sold the past 4 SPVs at approximately that sum. So we would expect to be give or take around that number, Sajid. I mean, at this point in time, can't say beyond that.
No, I'm just trying to get an idea of the valuation
Broadly
for
300
per
odd crores.
megawatt.
Broadly
Which is
300 odd crores.
okay. I'm asking this because in November, December, you had converted some of the debt and outstandings which you had with the promoters into equity shares at 80 rupees, 80.6 rupees per share. And you're coming out at 61.6, 61 to 65 in the IPO. Uh, what was the basis for conversion of that debt and outstanding? And you have reduced your valuation from November to now.
I think at the InoxGFL Group, we have multiple listed entities. I believe over the past over the past many years, as well as over the past couple of months, we've created significant shareholder value. We've met over 100 odd investors over the past couple of weeks, and based on guidance from our bankers, and also the fact that we believe we want investors to make money, we've priced it, I would hope and believe, attractively. And I think that's something which is reflected in the pricing. Yes, the promoters themselves have put in money at $80. So that just shows our commitment to the business. We believe in the long term. While it's a small company for the group at this point in time, we are very excited about the opportunity with the renewable energy services sector throws out. And, if I may say so, we hope to create a significant value for all our shareholders and investors, particularly the retail shareholders.
I'm little also wanted some kind of idea from you because you are in the O&M space and it's a services area. And as you said, it's a cash flow business and you should look at it as like an annuity business model. Why is that you've been loss making for the last 3 financial year and the first quarter of this financial year?
So, Sajid, again, importantly, at the operating profit level, we operate at upwards of 50% margin over the past 4 years. As you may know, until now, the EPC business was under this entity when the sector had shut down, and a lot of debt was under this entity when the sector had shut down. As things stand today, as I explained, once the debt goes out, basically the entire operating profit margin will become cash profit for this entity, given we'll have no interest. Depreciation is optical because we have no capex plans going forward. There is zero capex in this business, and we have significant tax advantages given the past 4 years of brought forward losses. So effectively going forward, we believe EBITDA is equal to cash profit for this entity. Historically, I already explained to you, but at the O&M level itself, the operating profit margin is upwards of 50% over the past 4 years.
I get that because I saw in the RHP that a large portion of the losses were coming from the EPC business, which you have now transferred to a BTA, business transfer agreement, to your promoter entity, Resco. And I think if I'm not wrong, it's around 53 odd crores which you are getting as a one-time payment for the transfer. What is the contribution of this EPC to your top line?
Well, historically, EPC used to be approximately 20% of Inox's top line. Going forward, we believe EPC will be about, should broadly reduce, given the fact that we've got a significant chunk of the common infrastructure already built, and larger players are developing common infrastructure themselves. So this should only be declining as we move forward.
A large portion of, or I would say the entire revenue is dependent on the kind of execution that Inox Wind does. What is the kind of pipeline or order book which you can see for Inox Wind? And based on that, what is the kind of kind of revenue for which you can do? Because what is the kind of relationship that you have between Inox Green Energy and one of Inox Wind, and for every megawatt of installation or execution that it does, or let me put it, the units are 2 megawatts and 3.3 megawatts unit you do, what is the kind of revenue that you get from them on an annualized basis?
So we've got a 3 odd gigawatt fleet at Inox Green at this point in time. This is thanks to all the turbines which Inox Wind sold over the past couple of years. And these contracts are at the Inox Green level. So Inox Green makes its own revenue to the extent of those 3 gigawatts of contracts. Going forward, we expect to grow this business organically and inorganically. Now, the organic piece is basically whatever turbines Inox Wind sells. There's an exclusive agreement between Inox Wind and Inox Green that all the O&M contracts for all the turbines which Inox Wind sells come into Inox Green. Inox Wind, as of 30th June 2022, had an order book of approximately 1,300 odd megawatts, which we expect to execute over the next 24 months. So I think that is something which we expect would eventually flow down to Inox Green on the organic side of it. On the inorganic side of things, I think what's happened, thanks to the transition which happened in the wind energy sector, we've got almost 12 gigawatts of assets in the Indian market where OEMs have gone bust or have exited the sector. And I think a big chunk of this is being serviced by the unorganized players. So we're looking at a lot of inorganic growth opportunities. And I think that's something which should play out post our IPO.
What do you mean inorganic is being the third party O&M providers for those assets?
That's right. So at this point in time, obviously, we're servicing all the turbines which were sold by Inox Wind. Going forward, we would be expanding into servicing turbines sold by other erstwhile OEMs who've gone bust or do not exist in the country.
How much and by how much, by what time will you be able to have a significant portion of non-Inox revenues coming in? Is there a timeline you have? Because today, as we speak, you are entirely dependent on Inox. You're talking about a huge opportunity outside. You have, I'm sure that there's a game plan which is there, but it's not been executed yet. So, will we see some kind of inorganic growth coming in FY23, or is it going to be next year when it comes in?
So, Sajid, I'm prevented from giving forward-looking statements given SEBI guidelines, as you would be very well aware. But yes, we do have a significant game plan in position. Once the IPO is behind us, I think we would be executing to a great extent on the action plan and the game plan we have in position. As you know, we are a large group. We have multiple entities. Our market cap is almost 50,000 crores. We know how to acquire companies. We know how to look at acquisitions, build businesses. And I think we are very confident we should be able to scale this business up significantly inorganically post the IPO.
You know, I was looking at your EBITDA margins for FY22 and it was around 47. I'm talking core EBITDA margin without other income. It was around 48% in FY22. But in the first quarter, it came down to around 28%. Any reason why it is? Is there a seasonality to this kind of revenue that you see in this segment, given the kind of wind cycles which we see in the country, or what is it actually?
So, Sajid, it's a steady state business. If it's typically 50% odd margins, that's what's going to be reflected over a say a typical 12-month period. I think what's also happened in Q1 to some extent, we had various pre-IPO related expenses which come into the P&L, number one. And number two, you have certain contracts which come in at the beginning of the quarter, some come in at the end of the quarter. So to some extent, just looking at on a 1 quarter basis will not be relevant. But broadly speaking, if you look at the past 8 years of pure EBITDA at the O&M level, we've been operating at thumb rule 50% EBITDA margins. And I think we are very comfortable operating at those numbers. We only expect this to improve going forward post the IPO, but I think we are very comfortable operating at those numbers.
Also, you are dependent on third party for equipments and supplies, if I'm not wrong. And that's something that costs, it's a comprehensive O&M that you have. So anything that goes wrong, you will have to supply that at your cost. So what is the kind of efficiencies that you work on so that the breakages and stoppages are much lower, and that also helps in improving margins for you guys?
So Sajid, we've had a 8 to 10 year track record, and within that period we've been managing almost 3 gigawatts of fleet on a pan-India basis across IPPs, PSUs and corporates, as I mentioned. The entire margin over the past 8 years, as I mentioned, has been upwards of 50 odd percent, give or take 3, 4, 5% on either side of it. So we have significant experience, significant empirical analysis, and some significant history which guides us towards these margins. Having said that, we also leverage Inox Wind's presence and the larger InoxGFL Group's presence to ensure our margins are in control. I would also like to add what we have at the larger Inox Green level. We have an industrial all risk policy for the entire fleet, which we manage. So barring force majeure and fire, which is under the scope of customers, we have insurance policies in place for the entire fleet. And typically, our insurance costs have only gone down year on year over the past 10 years. We are probably at the lowest level of insurance costs which are prescribed under IRDA guidelines. And that's primarily because our claims and our breakages are so low. What we guarantee or what we provide is a 95% machine uptime. And I think, having said that, across the fleet, obviously we strive to achieve way better than that.
I was looking at one of the crystal reports on Inox Wind, and they were talking about the fact that, while they had a stable outlook, you're talking about that operational weakness. They were looking at operational weakness because of low execution at Inox Wind. Is that been resolved? Where is it? Because their execution will depend or impact you directly with respect to your revenues, right?
So Sajid, let me answer that in three ways. Number one, I think the larger renewable energy sector has turned around. Wind has come back very, very strongly. So let's put it like this: during COVID, when hotels were shut down, right, your revenue was zero. Now, if you're going to look at the balance sheet and say over the past 2 years, oh, the hotel made zero revenues, and going forward it's always going to be zero, then that's a fallacy, right? So effectively, what's happened is the wind sector, as I mentioned, went through a painful transition from feed-in tariffs to auctions. That entire transition is behind us. COVID is behind us, as many of us would tend to believe. Within that, the wind sector is now coming back very strongly. So to that extent, we're seeing significant execution going forward. Number one. Number two, what's happened is there was a realignment in the group. We've pumped in capital thereafter. So the business has got its own capital. The IPO, the primary and the secondary piece of the IPO. Primary comes into Inox Green. The secondary piece comes into Inox Wind. And all of this is really being used to clean up the debt at the Inox Wind level, which goes a long way in terms of strengthening the balance sheet and making it a very, very lean and a very, very strong balance sheet. And thirdly, I think we've got a significant order book now, well spread out across public sector enterprises. We won almost 350 megawatts with NTPC over the past couple of months. We have a lot of retail orders, we've got IPP orders. So it's a very broad-based, well-diversified order book at the Inox Wind level. Also, what's happened is we've recently launched one of India's largest turbines, probably one of the most cost-effective turbines, 3.3 megawatt turbine, about a month ago. So putting these three factors together, the sector coming back, the balance sheet becoming very strong thanks to the capital infusion, a very strong and well-diversified order book, as well as one of the most competitive products in the Indian market. I think execution is not rocket science. Until the sector shut down, we were doing almost 800 megawatts in a year in a 6-month period. So frankly speaking, execution weaknesses only because of the sector virtually being shut at that point in time, and then the balance sheet cleanup which had to take place. So I think we are very, very confident going forward post the IPO and the sector coming back. We should be seeing Inox Wind going from strength to strength.
Mm-hmm. I wanted to get an idea of this the new turbines which are coming in, 3.3 megawatt turbines. How does it change the dynamics for the entire wind industry? How do you compare yourself with other manufacturers and I'm asking you because you're coming from the group perspective. So from a group perspective and from the industry perspective, the 3.3 megawatt turbine WTG, how does it change the dynamics for the industry?
Look, I think it's a game-changing move. I think it's one of the largest turbines in the Indian market today. It's so typically, the predecessor was a 2 megawatt turbine with say 113 rotor diameter. What we've launched is a 3.3 megawatt turbine with 146 rotor diameter. What that does is it increases the yield on a typical site by not just prorate. I mean, 2 going to 3.3 is a 65% jump. So putting aside the 65% jump, it increases the actual yield by upwards of 30% on a like-to-like basis. So what that does is if you're generating far more on an apple-to-apple basis, that's reducing your cost of energy by virtually 20 to 25%, if I may say so. So given that renewables is in itself the cheapest source of power today, I think the 3.3 megawatt turbine is going to lead to three things. One, it's going to increase yields, which makes more efficient use of the grid and the infrastructure in the country. Two, it increases returns for IPPs. I think people have been on a very lean margin side, if I may say so, given the transition from feed-in tariffs to auctions. So it increases margins to some extent for these guys. And three, it increases margins at the Inox Wind level as well. So effectively, everyone is happy. It's a win-win. It's good for the infrastructure in the country. It's good for IPPs and customers who can increase their margin to a certain extent, and in turn, bankers who have a little bit more cushion in terms of the risk. And at the OEM level, at Inox Wind, it increases our margins. So that's game changing. I think what it also does is it opens up access to a lot of other sites, which were low wind sites, given the fact that now the yields are much higher. So effectively, your competitiveness on those sites increases. So I think it's a game changing move for the sector. In terms of competition, as you asked me, I think there's frankly been a lot of consolidation in the sector over the past 4 years. As I mentioned, even on the Inox Green side, on the services side, we've got almost 12 gigawatts of fleet where OEMs have gone bust or have exited the country. A lot of the key players have shut down. They didn't have the financial might to withstand the pains of the sector for the past 4 years. So, if I may say so, there are at best 3 to 4 significant players in the Indian market at this point in time. It's really been, significant consolidation, and obviously there's been if I may say, to some extent, a shortage of supplies in the market, given the fact that now, after the painful transition, all the OEMs are obviously going to be making turbines only to make profit. We've all lost money at the OEM level for the past 4 years. So everybody really needs to now make money akin to what hotels are doing, thanks to 2 years of COVID, within which I think we probably have one of the most competitive turbines. I won't get into specifics of competition, but I think the top 2 or 3 players are give or take 3-4% plus minus in terms of efficiency. So I think I suppose, I hope that addresses your question, Suji.
Give me a sense of what is the kind of revenue that you earn per turbine or as part of the O&M services that you do, means whether it's 2 megawatts or 3.3 megahertz, just to get an idea of it.
So typically our revenue is about 8 lakh rupees per megawatt per annum. And typically we have built-in escalation clauses in our contracts where revenue keeps escalating at approximately 5% per annum.
Okay. And that's for the comprehensive one which you're talking about.
That's for the comprehensive O&M contracts, which is what is expected to going forward, we expect, I would say almost all the contracts to be comprehensive. Historically, we've had some of the contracts converted into non-comprehensive when the sector was under a lot of pain, because we thought let customers help us in terms of sourcing components and paying for it. But I believe a big chunk of that should move back to comprehensive, given the fact that it makes no sense, as I mentioned, for anybody to do O&M in-house unless the OEM is bust or the OEM is weak. And I think given where we are today, Inox Wind is strong. And with Inox Green's IPO, I think the larger renewable energy platform of the InoxGFL Group should be a very, very strong vertical.
There's a hyper competition in this segment, and especially a pricing of wind power. Will that put any pressure on services provider like O&M going forward, given the fact that you will be moving out from only Inox Group to non-Inox entities as well?
So Sajid, how I would answer it is, the hyper competition under auctions was in the period from 17 till, I would say, 19 end, when the sector was transitioning from feed-in tariffs to auctions. At that point in time, the OEMs had a lot of inventory. So for survival reasons, every OEM just kept dropping prices just to survive. I think what's happened is all the inventory issues in the sector have been cleaned up. Majority of the OEMs have gone bust. The survivors are the ones who are strong now. As I mentioned, inventory issues are cleaned up. So obviously now people are making turbines obviously only to make money. No one's going to make a turbine to lose money. So that period of tariffs dropping is gone. In fact, in the recently conducted auctions of GUVNL in July 2022, tariffs were bid out between 284 to 326. I would tend to think tariffs would stabilize somewhere around 3 rupees plus because of people wanting to make reasonable returns, not supernormal returns, but reasonable returns. Within now, beyond that, don't forget the only cost for a wind turbine owner is debt servicing, is interest and O&M. Now, besides interest, the O&M costs are typically at 25 to 35 paisa per kilowatt unit, which is approximately 8 to 9%. So effectively, someone trying to squeeze that makes no sense. And I think for the past 20 years, we've seen pricing being about 8 to 10 lakh rupees per megawatt per annum. With respect to the non-Inox group piece, which we would be moving into, we are primarily looking at taking over a lot of the inorganic piece which exists there, given OEMs are in distress or have gone bust. Now, within that period, a lot of the unorganized players are not financially strong, don't have the muscle power, and they're not organized. So that what we're trying to do is shift the entire sector from an unorganized play to an organized play. So effectively, while there may not be any pressure on margins, we potentially could see increase in margins because we will be providing far better service and far larger bandwidth in terms of management, in terms of the spare parts availability, and in terms of better uptime. So I don't see any pressure to that extent taking over unorganized players in the market.
Then finally, you're going to reduce your debt to near zero by the end of the fiscal. Is it fair to assume that in Q4 you would be turning profitable?
Well, God willing, at the green level, that is what we would want to do, and at the wind level. But again, we can't make forward-looking statements, Sajit, as you would well understand.
No, I'm talking from a point of view that the moment that your interest charges goes off after paying off your debt, the entire thing flows through to the to the PAT. So FY24 would certainly be profitable, in my estimate, but Q4 would also be profitable.
So Sajit, how I would answer it, given SEBI restrictions, going forward, what's in the public domain, our strategy is very, very clear. As you mentioned, to make this a net debt-free entity, number one. Number two, we would expect our profit margins to increase. We would expect EBITDA to increase, optical depreciation to keep decreasing, given we are not building common infrastructure facilities under Inox Green anymore. So yes, if that addresses your question, I would like to leave it at that, given there are SEBI restrictions beyond which I can't speak.
Thank you, Devansh. The Inox Green Services Energy IPO opens on November 11th and closes on November 15th. Price between 61 to 65 rupees. Fresh issue of 370 and offer for sale by Inox Wind of 370 crores. So total size of the IPO is 740 odd crores, and it values the company at nearly 1900 crores at the upper end of the price band. Thank you very much for joining us on IPO Adda. Thank you.